Well, stocks are hovering near the flat line. The S&P 500 and the Dow coming off of record highs, but the S&P 500 still within spitting distance of that 5,000 level. But some on the street are debating whether the recent rally can hold, given just a handful of stocks are driving all of this upward momentum. We've got Kristina Hooper live in living color in studio with us. She is the Invesco Chief Global Market Strategist, here to tell us more. Hey, Kristina, great to see you, first and foremost. You know, as you think about this move higher and this momentum into some of these new all-time highs, how much longer can it last off of the back of just a few names?
So I think there's going to be some period of digestion soon. It makes sense. We've had a very strong rally, and it has been, as you point out, relatively narrow. But I do believe that what we're likely to see is something of a rotation, that we are going to see smaller caps perform better and cyclicals perform better as markets start to discount a reacceleration in the back half of the year. Certainly some of that will be generated by excitement around rate cuts coming soon. They don't have to happen in March, but hopefully sometime in the second quarter. I'm targeting May 1st, and that could be a bit of a catalyst as well for the smaller caps and cyclicals.
So Kristina, between now and May, though, I think a lot of that debate or a lot of the talk here centering around the fact that if we get any sort of disappointment, if we do start to see weakness in this handful of names, that could potentially trigger a wider market drop, potentially a correction, given the fact that so much of this momentum is just in a handful of gains. How should investors be thinking about that and protecting their portfolio from that risk?
So I think investors should expect some level of volatility. What we've seen is that expectations around the Fed and uncertainty and confusion there have created bond market volatility, which in turn have bled into stock market volatility. So I think investors should assume that we're going to see volatility, that we could see some sell-offs. I don't know if I'd say we're going to get to the point of a correction. So investors should be, I think, viewing this as the potential for opportunities. What we know is that many have an overweighting to cash on their portfolios. That's probably not a good idea if they have a long time horizon. So I would think of this more as an opportunity, but certainly investors should steel themselves and be prepared for some level of volatility. Don't get out of the market because you get spooked, because there's a sell-off. That, to me, I think was the single biggest mistake investors made during the global financial crisis.
What is that best portfolio positioning that you believe investors can enact or implement if we do see the timing of rate cuts continue to be pushed out?
Very diversified. So certainly adequate exposure to equities, adequate exposure to fixed income, and some alts. Within equities, be broadly diversified. It's going to happen. We just don't know exactly when, but the Fed will start cutting rates soon. And as a result, I think we're going to see a weaker US dollar. So having exposure outside the US makes sense, especially emerging markets where there's growth potential. Within fixed income, lock in those higher rates now. Go longer duration, have some investment grade credit in there, but also have things like emerging market debt. And then finally in alts, maybe scoop up some of those oversold opportunities like real estate, dare I say.
Hey, Kristina, we're also getting some headlines out from Treasury Secretary Janet Yellen. She's talking about some of the stress that we're seeing play out within the regional banking sector right now, a lot of that being tied to New York Community Bancorp. But when it comes to the comments that she is saying, non-banks don't have access to backstop funding. She went on to say that concern in market stress could see a non-bank failure. And the reason why this is relevant is because of the role that they play in mortgages. How big of a risk do you see, or do you see the risk of a broader fallout here from what we are seeing stem out, at least right now, what seems to be relatively contained to at least one company?
So what I've seen thus far suggests to me this is very contained. Now, we can never control for market sentiment, right? It can run wild, even if it's not based on fundamentals. But based on what I see in terms of what's happening with New York Community Bank, it is very much one of only a few banks that share those kind of key factors where they had significant exposure to commercial real estate, low loan loss reserves. A lot of that had to do with the fact that they actually acquired part of Signature Bank. So they moved into a different tier and they had more onerous requirements that almost seemed to surprise them. So I think this is relatively isolated, but we do know that there can be a reverse halo effect that at least temporarily can affect other banks. And certainly we've seen the regional bank index suffer a bit as a result of guilt by association.
You know, one of the huge things that we've seen in terms of an overall theme that's been playing out as well. I know we were talking about broadening out this rally, but what if an investor out there says, you know what, AI and generative AI, perhaps this could be the next cloudification of companies' balance sheets, of companies' growth perspectives as well. How much more legs do you think that has to run as well?
Well, I almost analogize this. I'm so old that I lived through the late 90s and was in the business back then. So I remember the excitement around technology and in particular internet stocks. And the excitement was appropriate given all the potential that many saw. However, how it came to fruition over the 20 plus years since then, many did not predict. And so I would say there's an enormous amount of excitement around artificial intelligence, but recognizing that it may not play out exactly as people think. Certainly, I think it's going to add to productivity. There are going to be a significant number of winners, but we just don't know. I mean, there can be some zigs and zags along the way over time, but it does make sense to have exposure there. I would argue this is the kind of area where active management can really help.
Kristina Hooper, always great to have you. Thanks so much for stopping by with us here in studio. Invesco Chief Global Market Strategist. Thanks, Kristina.